All right, good morning, everybody. Just a reminder, there will not be a morning briefing tomorrow, Wednesday. We'll be back to the regular schedule on Thursday. So it looks like the markets are still waiting on data. It's the unemployment dual mandate of the Fed, right? They got to deal with inflation and they got to deal with employment. And they say they slayed the inflation beast, and that leaves employment as their number one focus and priority. So everything having to do with the job numbers becomes really important. There's talk about a lot less rate cuts next year, but they still want this last one this year. So we're looking at a plus 70% chance of one more rate cut here in December. On the back of the unemployment data we're going to get Thursday and on Friday, right? We got unemployment on Thursday, non-farm payrolls Friday. That is what the market is focused on. Behind that, OPEX, triple witching, futures contracts expiry, and FOMC, all just wrapped up back to back to back. Markets are calming down a little bit more after what's going on in Europe, France. It continues to be a little bit of drama, so you want to continue to keep your eyes in that direction. Our markets mostly were flat while Europe rose. Yesterday at 11:30, when the EU closed, saw a significant change in market dynamics and market structure after that close. I would expect the same again today. So keep your eye on the clock. Watch for that opportunity at 11:30. I mean, what else we got, right? There's not a whole lot while we're waiting on this data. The China ADRs are in the red, but just barely. I mean, really more flat than anything else. Same with Japan. Then the NASDAQ and the Dow, basically all flat. S&P and the Russell as well. It's just this hurry up and wait sideways market. Now, that's always easy as a benchmark to say, yeah, I think we're just going to go sideways and grind it. And that's what we've been doing. But we're in a really low volume environment, and that has to be taken into consideration. It won't take much of a spark to send this market in a direction. And I'm not being bearish here. That can be a bullish bias as well. Just getting out of the box, 0-day flows can rip this market in one direction or another really fast because there's not a lot of volume out there. So continuing with the whole jobs theme, we're going to look at job openings today. We've got some Fed governors chipping teeth, and then we're going to get some auto sales data. Now, we already seen Tesla down this morning. It's not because of this. I think they finally settled on whether or not he was going to get paid, right? If they were going to uphold that contract that they had made. And that seems to have brought on some moves in Tesla. But we do have auto sales today. So if you're looking for a cheap play, maybe something like Ford, GM, wouldn't hurt to take a look in that direction. But the unemployment or the employment situation continues all week. So we're going to get some today. We're going to get some tomorrow, then on Thursday, and then the big one on Friday with non-farm payrolls. So it's just going to continue to come at us all week long. It's one of the reasons that we saw the week's expected move so narrow and had a lack of volatility, is because they were expecting to see a sideways market into that data. Now remember with the JOLTS numbers, that's the take this job and shove it numbers. The grass is always greener numbers. The outlook or bias or perspective of potential new hires who think they could leave a job and go get another job very easily. So while it is employment data, it's not the big data that we're looking for. Just still, we want to keep our eye on it. Any employment data, we want to take it into consideration. So one thing that I continue to get asked is, should we short it yet? Can we short it yet? Can we short it yet? You don't want to short into all-time highs. You don't want to short into such strength that we've been seeing. And there's an old metric that still works really well to this day, and it's the 3-period moving average. Put it on a daily. I usually use the 3-period on the weekly. I point it out often in the morning briefings. But that 3-period daily is a really nice line in the sand. Right? It's a part of a 2 moving average combo that I call the surge indicator. So as long as we're above that 3, you don't want to try to short this thing. Now, don't get me wrong. I don't like to short from the hole. So if you're sitting around waiting for it to break the 3 and then short it, you're basically going to try to short from the hole. On the other side of that, if you're a trader who's looking for signals first, right, confirmation type trading, then that is a really good confirmation, getting underneath the 3-period moving average. Do with it as you will. I don't trade with indicators like that, right? Not looking for some sort of trigger to go long or short just because it went above or below a moving average. But it does offer a nice perspective. They bring up a chart, look at where we're at. Are we above the 3 or are we below the 3? As far as I'm concerned, as long as we're above the 3, I want to look for long opportunities. Doesn't mean I'm going to find any, right? If we're above the 3 and we're falling towards it and it doesn't present any long opportunities, then I'm not going to get any. But that would be the bias. Look for longs while we're above it, look for shorts while we're below it, and watch out for those transition periods where we're just crossing back and forth above it and below it. Really nice, simple metric. Every platform that has indicators has a moving average. So you don't have to worry about any sort of complex systems or anything like that. The average daily range is starting to compress a little bit. It was 1.06 last week. It's 1.03 now. So it's starting to shrink a little bit. And that makes sense because we're going sideways and it's based on our average daily move, ADR, average daily range. So we are holding in this really tight pattern here through the Globex. If we were to put something on like a Linreg and just snap it from Globex, there is a slight downward bias in that, right? I know it's hard to see, but that white line that I just snapped, it is gently pointing downward, not by very much. But if you're using OCR type analysis, you've got lower highs and lower lows, just continuing to represent that fade back to the 3-period moving average. I like using options levels. They work well. That 3-period is 60.56, but that's not very far from 60.50. And 60.50 is basically yesterday's RTH low. So base case estimate, we break our own Globex low and we get through the other side of that 3-period moving average, we're going back to 60.50. It's not some condition of bias. I don't think we're going to sell off into oblivion or anything like that. Just fade off a little, retest that 60.50. That would help us maintain the range that we're all expecting to maintain while we're waiting on the employment data. So 60.50 is the target to the downside first if we break our own Globex low and get through that 3-period moving average. take the whole of yesterday, the RTH and the Globex, and we've got the halfback, but I really don't think that's going to be much of a problem. That 60.52, if we get that close, just overshoot it into that 60.50 anyways. And when it comes to holiday markets and that sort of stuff, it can really screw with what we measure and how we measure it. While I just snapped all of this onto yesterday, Friday is still dominant at this point. So if we back everything up to Friday, just from the highest point to the lowest point, then you can see that we did get our breakout yesterday. We got into almost into the 1, 2, 3, 6, and we faded back. So if you want to just keep track of Friday's levels, that wouldn't hurt to do it that way. Could even use, there we go. That looks a little bit better. It doesn't change much, except that it gives us a 786, and that 786 is right at the 60.50. Imagine that, right? Couldn't make it up if you wanted to. So we are tangled up in a lot of levels. We're up against this 60-65 area. The longer we stay here, the more we're going to build out structure around it, right? There'll be unfinished business and trades up there, and there'll be unfinished business and trades down here. But we haven't been here very long, right? In the grand scheme of things, half a day isn't very long. Still, we're building it out, we're winding up, and I'm still leaning more bullish than bearish. So we're sideways into the data, but we could break out and expand and get into 6,100 before that employment data on Friday. There is a call wall above 6,100. We got the ADR half at 60.95, COG line at 60.92. We'll gravitate towards them if we get even remotely close. Overshoot that into the round number 6,100. Could even get to the call wall just from gravity, just pulling us up there. To the downside, if we break the Globex low of yesterday, we might as well just take out that ADR half. 60.32 COG line on the downside. It's the 3-week moving average. Get through that and get to the 10-day moving average, and it will act like a gravity. It'll pull us right down there. That would be Thursday night, Friday day lows, right? So, you know, if you look at the daily chart, it'd be Friday's lows. Open, high, low, close, the same 4 pivots that we always use. It's unlikely that we would see the round number 6,000 today unless something really negative kicks off. But getting down to Friday's lows, that's absolutely possible if we accelerate to the downside. We're not expecting that sort of move, though, right? It would take some sort of news. So when we turn off everything else and just put the ADRs on, you see how wide it is. Now, I mentioned that it's shrinking a little bit, but it's still a really wide ADR. And at this point, since we're basically flat on the day, we have no edge to try to build a bias in one direction or the other. If we were really close to one side, then sure, we could say, yeah, we're probably going to hit that ADR. But we got nothing at this point. So far today, we have an MDP. That's a missed daily pivot. Markets generally hit their floor pivot 80% of the time. And so far today, we have not hit it. So on the one hand, you could look at that and say, well, statistically, we're going to hit that because that's what we do 80% of the time. On the other hand, today's pivot is higher than yesterday's. The channel is completely outside of yesterday's channel and price opened above it. That's 3 different bullish checkpoints. So without hitting it, if we can break through yesterday's high, then we've got a nice expansion layout. and we can just keep on grinding to the upside. And tomorrow we would look back at today and say that was a missed daily pivot, because so far today it doesn't count. It won't count until the day is done. The reason we don't count it is because at any time we could drop down there and hit it, and then, well, it's no longer an MDP. Floor pivots have support and resistance lines as you move farther away from the floor pivot. These lines, I'm going to zoom out for a moment just so that we can see what they look like over time. So after the markets make a big move, the width of this range gets really wide because it's adjusted to the big move that the market had. And then when the market starts going sideways, these ranges contract again because it's looking back at previous days and asking, well, how big of a move did you make? Okay, this is today's range. So you can see that right now it's curled in. If we were looking at these like some sort of Bollinger Band, they're curled in. It won't take very much to get to an R2, R3, S2, S3, because it's a very compressed market right now. It feeds back into, we're waiting on data, we're sideways, we're IX10, we're just really compressed. So if you're using any sort of metric that says, 0-day iron condors, butterflies, to try to play the range in a mean reversion, if we get to R2 or R3, I would be careful with that sort of metric on a day like this. It's an old market adage that talks about how when volatility is low, it has nowhere to go but up. And we know that that's not true. When a market has a low volatility, it could just stay at low volatility. And yet that's what traders prepare for. Whether you use, a DMI, ADX, implied vol, Bollinger's, when volatility is low, it has nowhere to go but up. Expansion and contraction. So if we're in contraction and we're squeezing, even if it doesn't meet the definitions of a squeeze, we are compressed. The expansion is going to come. It's a given. It has to at some point. On the discussion of breaking to the downside, we have last week's point of control about 60-20, and 6,000 covers most of the value area high and value area low. So if we get to 6,000, we're already through the largest volume of last week. 59.92 cog line would be just about the line in the sand. It's the close of 2 weeks ago. Really close to the cog line, 59.91. It's likely that if we break that, then 59.18 or 59.11 cog line, the point of control from a few weeks back, becomes a target to the downside. Otherwise, we're looking for a continued expansion to the upside if we break out. And remember, the base case argument is that we're not going to break out, that any breakout will fail and that we will come back in the line again. So we're at 51 this morning. It's a little light compared to what we've been seeing, but it makes sense with the backdrop that we're in. So that low volume if this was a typical normal week, would probably cause us some concern. We'd be looking for some hedging activity, some threat or reason why it's so low. Maybe checking at other nations to make sure they were even open yesterday or last night to make a more informed decision of why the volume is so light. But we already know with OPEX and holidays and everything else, this is par for the course. So it's about what we expect. $10-day, 30-minute volume profile. It's back. We brought it back up again. As we continue to lose more of these candles on the left, building out new candles on the right, this volume starts to decrease, and it moved the point of control up to this 60-14 area. It's not a surprise. We talked about this yesterday. Yeah, I've heard about that. Oh, airports and snow, huh? Good times. So this isn't a surprise. What would be a surprise at this point is getting underneath that. It's likely we'll get trapped if we do. So coming down and testing off of it, getting a little Busby on it or something wouldn't be too much of a surprise. Really don't want to see even that sort of weakness. But we definitely don't want to get underneath it. If we continue to chop at our current location, it's likely that we'll bring that point of control up to us. Remember that where it's at right now is built on this small amount of trading. So just kind of clean that up just a little bit there. All of that volume came from just that small amount of activity. And we're already building it out here. So, you know, it's not inconceivable that we bring the point of control on up, and we can see the TPO building out here. So if we stick above 60.50 for another day without really breaking into new highs and continuing to expand, I think we move that point of control up this week while we're chopping and waiting. When you put the Linreg line on it, everything is still very clear. Don't want to short into that. All right, so we kept the POC yesterday, changed it from a VPOC because it was tagged at the Globex yesterday. Got a one touch play on that thing right before the open, and then that was it. After that, we just crossed back and forth through it like it wasn't there. And that ends all of that. Now, we don't have a new VPOC. Because if we tried to put one on, you can see that we've crossed through it multiple times. Again, the textbooks will tell you to carry it forward anyways, even if it's not a VPOC, just carry it forward. I don't know, maybe I grabbed that line at some point and moved it. Get it moved, put back where it belongs. 60.15. So we do still have a VPOC down here. But we don't have a new one from yesterday. I'm pretty sure we don't have anything overhead to deal with. It is worth mentioning we still have that gap to close too, that 60.32 on the SPX. it didn't get that done yesterday. So we're no longer IX10 on these candles from back here. We're done with that. We broke out. We kept the breakout. We are inside day at this point. So, you know, today's candle is inside of yesterday's candle. We're inside day until we break out. If today closes inside of yesterday and then we open tomorrow, we'll be back in a new IX10, right? It's inside day times 2 or more. But we're no longer in IX10 from that structure from last week. So we did break out of it. We kept it. Now we just got to do something with it. Technically, it's possible for us to break back down and get back inside that zone. That'd be more of a fake break fast failure than readmission into an IX10. But there is the door also, day 1 open range, DOOR. The way door works is there's a 1-day open range where you literally just use a single day. So you would take yesterday's range from its highest point to its lowest point. Mark that for the whole month. Other analysts use 3 days instead of 1 day. So even though it's still called day 1 open range, you use the highest and the lowest point over that 3-day period, and you mark it for the month. Looks a bit like that, right? We'll just zoom in randomly here. That was the start of a new month, the yellow candle. The next 3 days are the 3 days of the door. Mark the highest point and the lowest point, and that became the open range for the month. It's very similar to like a 5-minute open range, a 30-minute open range, 1 hour, you know, except it's on a daily chart and you use it for the whole month. Well, we started a new month, so we've got a door started. I do got to say, though, when it comes to the futures, I have not been really impressed with this, right? Equities, that's a completely different story. I have a lot more interest on, say, SPY, the Qs, Apple, anything like that. For the futures, not so much. Still, it's worth considering, you know, we're building out that 3-day level right now. We're still holding above the 10-day, and we're not overbought. We're not above 1.25 or 1.5. So everything is fine. A slight decrease if we're thinking about a wave, you know, we're kind of moving back towards the 10. Price doesn't have to move. The 10 will come to us. So if we just stay here, we're going to see this go to 0 because the 10 is going to come up and tag us. But it's just a part of the sweep, part of the curve. This is good. It's healthy. There's nothing wrong with this. We're not overbought, overextended, anything like that. Looking at the 10-week. Put a little time on it. 2.5% above the 10-week. That's just a good spot to be. If I put my mouse there, you can see we've been higher than that many times. So we're not overbought on the weekly. We're not extreme. We have plenty of room to move to the upside if that's the direction the market wants to go. So we are starting to curl over a little bit. And that can mean that we're going to see a correction. The thing is, corrections don't have to be price moving down. It can be the moving average moving up. So a correction in time rather than a correction in price. Everything still looks really healthy. Now, this isn't the format for market breadth and internal structures. You know, looking at advanced decline on the major indexes and all the macro and micro things, this isn't the format for it. There's a lot of risk out there right now. A lot of tools that are signaling danger, divergence, overbought, topping out, use whatever metric phrase you want to use. But we're still grinding higher. So, it can look as divergent and scary as it wants, but the money is still flowing into the markets. Bonds, Bitcoin, the VIX all down. It was interesting yesterday on the VX. I tend to look at the VX futures more than I do the VIX. The way it was explained to me long ago is traders look at the VIX as a way to gauge volatility in the markets, right? Like a tool. And that's fine. Retail likes it. It has a lot of widgets and publications, and they talk about it on MSNBC. But the VIX futures is where the institutions actually trade it, right? So where they put their money. They can talk all they want, but we want to follow the money. Keep your eye on what the VIX futures are doing. Have a better idea of what the market is pricing in terms of volatility. The way that I like to say it is the VIX is just a really fancy way to measure the volume of the trades on the SPX options. That's it. I know that might be overly simplistic, but if you look at what the VIX is made up, what it's looking at is the 30-day SPX options. So this is just a really fancy volume tool for the options being traded on the SPX. I think I'd rather look at something else, right? If I'm trying to gauge the level of volatility, doesn't mean you want to ignore the VIX. We still need the perspectives of the 3-month VIX, the regular VIX, with 1-day VIX, but the VX futures, this is where the money is traded. And it continues to fade, right? And we're getting a little pop this morning trying to stay inside of yesterday's range. That's why that red candle is hollow, because it's rising. But we are still below the close of yesterday. And I think if we get this breakdown today below yesterday's low, that we could get an expansion continuation to the upside in the ES. We had a lot of divergence yesterday between the ES and the NASDAQ and the ES and the SPX. There were periods of time yesterday where the SPX was down inside of its own range while the ES was breaking out onto new highs of the day. That arbitrage didn't stick. It wasn't there all day long, but we were seeing that sort of divergence. So there's just a lot going on. You've got to be mindful of the different forces pressing on this market right now. The dollar, yields, bonds, other governments around the world. Don't just watch the one chart you're trading, right? You're trading gold, oil, the ES, the NASDAQ. Don't just look at that. Whatever you're trading is being influenced by something. Kind of want to look around and see what the heck is moving out there. So this is the gap that needs closed. I mentioned it earlier, that 60-32 cog line on the SPX. Gold miners, emerging markets, those are up this morning. Emerging markets, but the China group is only up, about 0.25%. We need that at least 0.5%. So sure, it's in the green, but that's not as green as we need it to be. It's the market waiting on data. We've seen a really good push in semiconductors yesterday. It's been a tug of war between the chips and software. So if we're seeing a run in one, I'd look for a fade in the other, and vice versa. Got an inside day breakout on crude. We've been getting these lower highs and equal lows. Then we started flipping it back up. Now we're getting a higher low. We got to run up and break this lower high and set a higher high to begin a transition and sort of turn this back around. And that $74 has been a line in the sand. That's the year-to-date anchored VWAP. Got to get past it. So if we're driving to the upside, that's the target. Got to get through that first, then get through this peak, call it 74.50, set a new high. That way we have a higher low and a higher high. That would actually give us two higher lows and our first higher high. We were doing a lot of talk on failed bear flags a while back. And one of the metrics on my failed flag is the 786 and the idea that if it's a bear flag, that it won't go lower. We'll actually turn around, get through the 786 and begin working our way back up again. So that's the flag and that's the pull, right? Typical bull flag, bear flag, pennant, anything like that. The flag, you don't want it to extend too long, right? If it begins extending too far, then it kind of invalidates the pattern. If this is a failed flag, then we'll run back up the other side. That would be the pole. That would be the flag. Then we run back up the other side and it builds a big old cup. If it doesn't fail, then we have the pole, we get the flag, and then we continue to the downside in a continuation pattern. The metric or the line in the sand is the 786. We're looking to get through that, get a breakout to the upside, back through the half, and work our way back up to the top. At this point, we already had the breakout and it didn't work and it came back in again. That's not good. So it does put the 111 on the table for a move to the downside if we can't get back out of this box. So at this point, we do have a failed flag forming, but it hasn't failed yet because it didn't stay above that 786. And really, this fib is set to quadrants, so it's not even a 7.8, it's a 7.5. I would say it didn't even make it through the 786 and it came back down. So it's not looking good at this point. Not for a failed flag play. If you're trying to get long in the precious metals, I would see if we can get a retest on 27 and or wait for the confirmation of the breakout. That way you're at least going long off the lows on an LRE. If it doesn't go back down there to let you in, then you can try to play the range that we have from like a quadrant level. That way, catch it on the halfback, right? That 27.90. Go back to silver for a moment. We are about to cross up on that MACD daily, by the way. Takes a little bit of time, but that would be the start of a new run on the MACD. Now gold already made the cross and then it stalled out. Right, been just chopping down here, much like it did back here, and we went sideways here. Still looking at this anchored VWAP on GLD or GDX on the miners. So if we break that low, then kind of reinforces the idea we're going to come back and revisit the anchored VWAP for the year. So that's what's dominating our upside market this morning. Crude, silver, miners, uranium. We're not going to get a rally breakout in the S&P and the NASDAQ on precious metals and crude. It's not going to happen. We need the Mag 7, technology, consumer discretionary. We got to have those, or we got to have just straight up 0-day options flows, which we can't see in pre-market. So we don't know if there's going to be any of that or not. Bonds, Bitcoin, and solar are down on the other direction. We kind of want Bitcoin to at least flatten out. It doesn't need to rally, but it needs to flatten out since Bitcoin is a condition of risk or a sentiment of risk. So, if we want a risk on marketplace, then we don't want to see people fleeing from risk. Plus, it ties in with the chips, semiconductors, payment systems. So at the very least, it needs to quit falling. Be even better if it started to rise. Maybe get a bounce on yesterday's low, begin the work of closing this gap or something. The rest of these bonds are just reacting to what we have, so they're not driving the bus. And solar and nat gas are irrelevant, so they're not the problem. Which puts Bitcoin on the radar today as one of the best indicators you could have for a long opportunity. So I got for you guys, be careful, be safe. No morning briefing tomorrow. I will be back Thursday morning. I'll see y'all then.